Joining us this morning on Studio 10 is financial expert Dale Gillham. Hi, Dale.
Hello. Finance expert Dale Gillham from Wealth Within. It's nice to see you again.
It's amazing listening to a professional trader who's doing what you're aspiring to do and hearing it firsthand.
Too many people ring me up and say, hey Dale, I want to make quick money, but it's not about getting rich quick. I think we can go for about 4 hours, but I'm not sure my wife would like that. So
I'd say congratulations for putting your time and effort out there, because you probably don't really have to do it. You're successful traders in your own right.
Thank you very much for opening up my mind with trading.
So of course you can succeed, of course you can, and you're the only one holding yourself back or succeeding, and that feels very empowering actually.
A quick reminder before the show starts that this live stream is an educational tool, and as such your personal circumstances have not been considered. We hope you enjoyed this week's show.
Good evening and welcome to the Australian Stock Market Show. It's so important that you keep your finger on the pulse of the market right now, as there are forces shifting across the globe that will create significant opportunity for people who remain focused. Each week we'll reveal more insights that will help you to broaden your understanding of the market and share with you what you need to learn to help you to take advantage of what lies ahead. Our topic for tonight, predicting the stock market's next move month by month. Tongue-tied there. On each show, we aim to answer as many of your most burning questions, investing or trading questions, including an opinion on where your favourite stocks are headed. Boy, do we have some really interesting stocks for you to review with us tonight. Before we get into the juicy part, though, of tonight's show, we'd like to applaud those who are really thinking about the best way to get educated now, so that you're ahead of the masses. If tonight's your first time watching, thank you for tuning in and well done in making the commitment to learn. We look forward to sharing many more evenings with you. Each week of the month we rotate through different markets and share our thoughts on the charts to keep you informed. Remember, our goal is to make sure that your trading and investing journey is easier and safer by informing and educating you on the realities of successful investing and trading. Hello, I'm Janine Cox, and joining me tonight, of course, is Dale Gillham. We're Australia's most trusted stock market educators.
You used some big words in that, didn't you?
Yeah, you were just sitting there listening to something new, weren't you, tonight?
I'm thinking, where the hell are you going? Every week I'm going, where the hell are you going, girl? What are you doing to me?
I've just got to keep him on his toes, don't I?
30 degrees in Melbourne today, sunshine, perfect weather, and my pool looks like crap because the pool guy hasn't been for months.
So you couldn't dive in?
No,
you didn't want to
couldn't.
risk it, but if you went down the river, you'd be swimming with all the duck poo, so what's the difference?
Yeah, I think, no.
You haven't thought about it like that, have you?
No, I haven't thought about it like that. But the Yarra River, well, the Yarra River is cold at the moment still because it's all the melting snow and everything else. Because do you know where the Yarra River starts?
Oh, I can't remember now, but I have been up there.
I bet you everybody's watching those. It starts at Mount Beauty, I think. Mount Beauty or Mount Donaby, one of the two.
Yeah.
So it starts there, but it's cold by the time it gets to my place. So don't really want to know about it. But that's okay. But everything's going really, really well. But my wife made me go shopping on the weekend because the shops are open now.
I know, you poor thing. I feel sorry for you.
2 days of shopping, guys. It's 2 days of shopping. Please get me out of here. Let's get back into the market anyway and move on with the show. But what's our first thing we're going to do tonight?
Well, you wanted to talk about the ongoing reports that we're putting up on Flicks as well.
Oh, yeah, the Flick stuff. Yeah,
interesting stuff coming up.
Yeah, well, we were putting up our US market report on YouTube every Tuesday, but that's all up on Flicks. So just go to Flicks. It's changing every day. Flicks is sort of moving out of beta version now into something else, but there's some really good content on that. So just go to flixx.net. My interview with Jim Beach that I do every Monday is up there. It goes up every Tuesday. There's other interviews like with Mally Alejandro that was up today, I think was today. Manny's from New York. He's listed up high up in the NASDAQ. Some great chats with him. We've got great chats with Michael Waits from Bangkok, who was in part of Morgan Stanley and that for many, many years. Very educated person on the market. We've had money coaches. Yeah, we've had property experts. Who else?
Todd Miller. Yeah, it was Todd Miller, wasn't it?
Todd Miller. We've had so many people. That's not funny. So get onto Flicks and you'll hear us interviewing it. And soon we're going to be doing lots of Australian experts as well, outside of Janine and I, of course, the experts, but we'll get onto that. But remember, if you do have a question for us, you can send an email or upload a 30-second video of yourself to our Dropbox or just send us a link. And remember to send all your questions through to info@wealthwithin.com.au. And I want to get some ladies on, with videos. We've had all guys on the videos. It's real easy. Webcam, phone, whatever it is, just shoot us an email. But that's what we need you to do. But to me, I just want the ladies to give us a video.
Right.
Just to even it out a little bit.
Somebody do it. Put him out of his misery. Moving on, it is the first Tuesday in the month, and that means, I know he's not going to do a drum roll, so let's keep going. We'll look at the Australian market. So let's get into the charts right now, shall we?
What's on the screen? That's not the Australian market, is it?
Yes, we have. Market? Yep, I thought you'd know this off the like the back of your hand. You look at it every day.
I know, but it's going all over the place at the moment. So.
I know, it's crazy, isn't it?
Yeah, I know. I mean, I was expecting, obviously with the election, I was saying to Jim Beach last week, I said, the market's really been going sideways, since sort of May, June. It's just been in this big sideways pattern right through here.
When you say pattern, it is a pattern, isn't it?
Yeah, it is a big pattern. And you just see it sort of goes up on tiny little stairs, but it's just really, since if we look at, actually, if I go in here and I just put on, actually not that one, if I click on that one, geez.
You need some practice.
Click on the right thing, Dale. If I go sort of between here and here, you can see here between that, there's something like 24 weeks between those two levels. Now, obviously, at the close of business today, because today was a pretty strong day with the All Ords up about 2% today, you can see there it's 11.62%. It's moved in 22 weeks.
So do you think that Australia is just waiting to see what's going to happen in the US?
Yeah, I think there is. I think it's very much so. But if I go to here and look at that, and go back down again, so you can see here in 23 weeks it's only risen 6.5%. So it really is going sideways, and even definitely from here. But
are you trying to be perfect?
No, I'm not trying to be perfect. I'm just saying to say to people, the market's still in a state of indecisions. We had that one big week up, and then sort of two and a bit weeks down through here. But if we look at today on the marketplace, we can see this big bar here today. So we look at that 139 points on our market.
That's impressive. Yep.
About 1.5%, I think it was, if I use my little tool here. So you can see from the close on Monday, it's 1.7%, and it was up over around 2% at one stage during the day. But looking at this, it was due to go back up 1 day or 2 days, but I think you need to wait for the end of the week at the moment, and that's the point. I think right now we're not sure whether this is just a little bit of a bounce, and we see people jump in thinking it's had us low, it's going up again now. Yeah. But anything can happen with the election.
Oh, it's done this before where it's gone up for a day like that.
Yeah,
and
so
then reversed.
To me, it's still likely, I think our market is still likely to head below that low over the next week or so. I think looking at the US markets, looking at those earlier today, we saw the NASDAQ didn't do too much. The Dow and the S&P went up over 1%. On Monday, but the NASDAQ didn't do too much, whereas last week the NASDAQ fell on Friday like 1 or 2% on its own.
Right.
So they're a bit out of sync at the moment. So we've got some pretty interesting companies reporting this week. In the US, we've got a lot of their financial stocks reporting this week. So up till now, we're seeing a bit of 50-50. A lot of the tech stocks have done well, but Apple's falling away and some of the other tech stocks are falling away, and they're taking the NASDAQ with them. And Jim was saying, well, if they're doing good reports, why are they falling away? And I said, well, because when's the best time to sell something? And he goes, I said, well, when everybody else wants to buy. And when they want to buy is when the best news is coming out.
Look, I mean, I know you like talking about the US market, but I just want to come back to the Australian market just for a little bit.
Yeah.
I think the RBA's decision obviously was weighing on the Australian market and affecting whether it was going to go up or down, and people were really uncertain about which way it was going to go. So I think, that's obviously been an important factor.
But is that enough? I mean, I know we've talked about the interest rate.
But it's short term.
It's very short term.
Yeah.
And we've had a couple of interest rates drops, if did I say that right?
Yep.
And they really haven't stimulated our economy, have they?
No.
So what is today's rate drop going to do to the economy?
Well, when you've had pessimism for as long as we have had over the past X number of months, it's much harder for the market to break out of that in the short term. We've got to see something positive coming through. So whatever that is going to be, it's an unknown at this stage.
Yeah, so just be sitting on your hands, guys, and take it easy. Don't jump into the market just because one day's up. Really, we do need to wait for the end of the week to see where the market is. But just keep checking at the market, and Janine and I will always keep you up to date. But now, before we get into our first viewer question tonight, I really did want to thank all of those who did send an email through to us. Really do appreciate that every single week. And if you're somebody who's been sitting here saying, I've got this question, but I don't really want to send an email in, you're the ones we want to hear from. We don't want to hear from the same people every week. Please, if you've got a question, put it on an email and send it to info@wealthwithin.com.au and we'll bring it up on the show. But first up, we've got a video question, and this one is from Shane. So let's take it away, Shane.
Hi Dale and Janine, thank you very much for your show and all the knowledge that you provide. Dale, on yesterday's show you talked about, I guess, some of the bottom 20 stocks on the market, and one of those you mentioned was SCG. Just wondering if you can have a look at that. I bought it back in June after I thought there was a downward trend line from February through to May, and then June closed a bit higher. So I bought it back then. It seems to have just gone mainly sideways since then. Appreciate your thoughts. Thanks.
Okay,
All right.
so he was a good-looking dude, wasn't he?
Oh, I love his hair. He's got great hair, hasn't he?
He's had great hair. He sort of looked like me when I was
You'd be
younger,
jealous of
but
that,
I
wouldn't
had
you?
blonde hair when I was younger.
The only thing is that it's the beard thing that's all the guys have. It's supposed to be trendy and following all the footballers, isn't it? To have
No,
the
I've never
facial
had a
hair.
beard. I've never had a beard in my whole life, but we need to get to his question. So,
Okay.
Because he has asked the question, so we better
Let's
ask
get
it.
on to the fact.
I actually didn't talk about the bottom 20 stocks, so that's one thing he misunderstood. They were the top 20 stocks, but they were all bearish.
Right.
So I was looking at what they've done this year.
Yep.
And looked at the top 20 and saying, well, where's the opportunity coming? So you know how we look at it and saying, okay, well, a lot of the energy stocks have been down, you know, like your oil searches, that sort of stuff. And looking at
Woodside.
just looking at those top 20, because the top 20 are the ones that drive our market. So if the market's going up or down, it's those top 20 that are doing that. And that's really what I was talking about, saying, well, where do you find value in there, and where are we looking at moving forward? Where
Okay, so you mentioned this stock. So SCG, it's obviously been in a decline into early 2020 with COVID.
Yep.
It was already looking like it was weak before that
Correct.
happened. So COVID just helped flush this out. Now, if COVID didn't happen, it may not have fallen as far. He's looking at, did I have a trend line down that move there? It's possible that there was a trend line down there because it's got even though
So
it's
where
got
did he
that
say
sharp.
he bought it? I couldn't quite hear that.
Well, he was talking about June, sometime in June, I think, because he had a trend line from around February down that slope. So sometime in June down here, he's bought it. So he's tried to get the trend line in here, coming down across those tops there.
Which he couldn't have got.
He may have got a trend line in there. Look, it depends how it lines up. If you lined it up, you might get one in there.
I don't think you will.
Because you got well, do you want me to go through why?
No, that's okay.
Well, I'm going to say that you potentially could get one there. So
I'm disagreeing with that. I don't think there's
he
one
may
there.
actually be correct in having his trend line in there.
We'll find out.
But it was a question of whether his entry would have actually been there. He might have been able to get the line, but it's a question of whether the actual rule would have been triggered or not. So that's really the point there. So look, it's good that he's had a go, and it's good that he's looking out for these opportunities where stocks fall into these lows and then they rise out to see if he can get a trend line valid in there. But he's also mentioned that he's going to start the course. So he's going to know once he's doing Module 3 of the short course how to draw trend lines properly.
Yeah, we're going to make you a trend line tragic, I think, Shane.
We don't want to spoil it for you at this
line.
point because you've got a lot to learn and you need to get to that point.
He'll be a trend line
properly.
warrior.
Yeah.
He'll know exactly what he's doing.
So, I mean, the point is, though, that he bought the stock. It's fallen down. It fell down here in August and then started to move back up again. So, if we were holding this stock, we wouldn't be looking to sell it at this point. We'd be waiting to see if it pushed higher and took off through around $2.30. If it pushes higher, then, and there are other rules in the course that may be triggered. But if it continues to fall down, then I would be seriously looking at where your stop loss is and remember to have something in there. Nice stop.
Yeah, it's been a little bit volatile, but yeah, I mean, obviously at this point in time, I'd agree with you. So.
All right, we have our first email question from Dinesh. Hi, Dale and Janine. Can you please give your thoughts on Boral Limited for a long-term investment? It looks like it's giving trendline entry on 5-yearly monthly chart. If more spending will happen on infrastructure to come out of the recession, this looks a good investment. Below $5. Appreciate your thoughts and thank you, Dinesh. So we've got here Boral. Now, Boral is quite a volatile stock. It's not the sort of thing that I would look to try to hold long-term. At times you can trade it medium term. When I'm saying medium term, it could be that you're able to hold on to it between 6 to 18 months, but at times it pulls back so hard that it's likely to take you out of a lot of rules along the way. So it tends to be more a trading stock, and you can make a really good income out of a stock like this over a number of months as it rises if you've got the right rules for it.
Yeah. Go ahead. He said it's trading above a 5-year trend line.
Yeah. So, I mean, if he's drawn a trend line down there, it may not have gone too much further than the trend line entry where it is right now. So, but it may meet resistance around that $5 mark. So at the moment it's trying to push through.
So he's talking about trading above that sort of area there,
yeah.
which is what we talk about in my book.
Yeah. So in theory, it could continue to rise from here. It's just a question, you need to work out how far it's likely to continue to rise based on some bigger picture analysis. So when you're looking at a chart, it's not just having a rule, it's because the short course gives you the opportunity to be able to work out what rule is going to work best over the history of a share. But the diploma course actually allows you to work out how high a stock is likely to run before you get taken out. So that's a really important part of it. And when Dale and I are looking for levels of resistance and where the stock might turn, there's a whole process that goes into determining what's more probable. So look, it looks like it could continue to rise from here. Last month it was looking weak because it had closed right down on the bar. Yeah. And so far it's only very early in the month. And this is why we don't know whether it's coming into a short-term peak or not yet. So, but it's a question of your rules. If you want to use rules that say, well, once the stock's actually broken above a trend line and you're happy with that and you've got your stop loss in place, then, you know, there's a rule there. So,
yeah, there's a rule there. It's just whether it's going to find some resistance soon or not.
And then it's about setting the stop loss. So, because if you're trading longer term, you've got to think about setting a decent enough stop loss, not too tight and close under your money, because otherwise you'll just get taken out at the next dip. Because look at the volatility of this thing. Yeah. You've got to have a look at how far this stock falls before you trade it as it's trending and understand it.
And it's not a buy and hold stock, as you said earlier.
Yeah,
so
that's
really
right.
From that point of view. But anyway, let's get on to the next question now. Okay. So our next one is an email from Janine who says, "Hi Dale, thanks for hosting the show. Can you please provide your thoughts about Zipco share price, ticker symbol Z1P in short-term and long-term regards, Janine?" So Z1P.
Now, we had a question about this some time ago, and we were looking at the significant gaps on the chart of this stock, and we did say at the time that the real risk is that it could come back and fill that gap, which it looks like it's trying to do at the moment. So if I was looking at this stock for one thing, I wouldn't be looking to buy it. It's come off the top of a significant peak there, that all-time high, and it doesn't look like it's strong. So that's always a sign to say just wait for better opportunities to come. So if he was holding the stock, then he needs to make sure that he's got a good stop loss in place for that downside. In the short term, it might try to push back up towards the $7 mark. There's a possibility of that. If the market goes up, then it could be supported by a market move. But the risk is still to the downside at the moment.
Yeah, it'd be interesting to see where it ends up this week. You know, if it breaks through that low there, then it's probably going to head right down to around that $4 mark, I'd say, or below $5 at least, I'd say. Very, very much
But
so.
look, if you look at any month, a stock can, you know, gyrate within a range any particular month. So it might move within the range of a previous month. It might not just fall straight like a lead sinker away from it. So that's one thing you've got to look at, especially with smaller stocks like this, how they trade. Do they just move straight up and straight down, or do they spend a bit of time moving sideways within the ranges of previous months?
Yeah, absolutely. So probability is what?
So probability is to the downside. If it, like you said, if it takes out that low, it's more likely to fall. If it goes up at the end of this week and closes high, there's a potential for it to get around $7 or thereabouts, maybe even a little bit more. But then you still don't know if it's going to fall away from that point.
Yeah. Did Janine, I can't even say his name, Janine, did he say he actually owned it or not?
I can't recall now whether
anyway, but if you do own it, mate, just make sure you got a stop loss on it. If you don't own it, sit back and wait. And wait for it to have a direction, because right now we're thinking the direction is probably more likely to be down. But
okay,
how's that?
That's great. We have a question from Jake. Hi Dale and Janine. I'm looking forward to taking a position in BHP at some stage, as I view this as a mine commodity ETF. Oh, okay, different way of thinking about it. Given its size and diversity, I previously held from April, waited till ex-dividend and sold when I felt the price was turning south. I was hoping it would come back to fill the gap at around the $32 mark. Would this be a good entry point for a medium to long-term hold? How much weight do you put on the overall commodity price when trading the miners? Thanks, Jake. Look, these mining stocks do move very much so with the commodities that they're mining, so that it does have a significant influence on the share price, but at times they will move outside of those movements. It could be oil and iron ore could dominate depending on the particular stock you're looking at. But BHP, as we've said for some time now, was due to come back to fill that gap, and it started to do it already. This week it's an inside bar compared to the prior weekly bar. You can see on the right-hand side of the chart there. So there's a potential change in commitment, but it may only be short-term before the stock comes back a bit further. So it's just something to keep an eye on. But I think the concept of trading BHP like an ETF is probably okay because it is such a big diversified company, but it's still not immune from stock-specific risks. So there is an ETF allows you to get exposure to a broad range of different investments, whereas BHP obviously is specific, and it's going to move differently to other mining stocks. If you look at FMG, it's moved incredibly differently. If you look at Rio, it's similar to the way that Rio's move, so often they move together, but there'll be other mining stocks that it will look completely different to.
Yeah, I mean with BHP, the two major things that affect its price are the commodity price and the Aussie US dollar.
Yeah, that's right.
They're the two things, whereas an ETF is more diversified. So whilst BHP is a diversified stock within itself, but it's not that diversified. That's what you're really saying, isn't it?
Well, I'm saying it is diversified, yeah, but it's not, I wouldn't think of it as an ETF.
No.
I mean, I think it's a nice way of, I thought it was really unique to hear someone send us in an email about that. He's just really thinking differently, which is great.
Yeah, I do like
but
it.
I think to trade stocks in the top 20 is a good decision anyway, because they've got exposure to more cash. So the liquidity is much higher in these types of shares. But the main thing with any big stock, whether it's a BHP or even a smaller miner, is just to have a look at the volatility on the chart, regardless of what it mines. So BHP can be quite volatile at times.
Yeah, so it may fill the gap down to 32, and if it does and finds support, it could be good buy later on.
That's right.
That's pretty much what we're doing there. But I've had a few people still with my book. You know, I keep saying my book's for free, just pay shipping.
Yeah.
So I've had a few people with that saying, I went to the shop and it...
Look, it's coming up to Christmas time too. That's another thing to think about.
Yeah, I just want to explain to people there's actually two books. There's one we're giving away for free, just pay shipping. The other one, you just pay the normal price. And this is the one that's free, just pay shipping. It's How to Beat the Managed Funds by 20%. You just go top left-hand guide, I think it is, top left-hand side of the our website, click on the button, you just pay the shipping and you'll get it. So from that point of view, the other book that I've got is my Accelerate Your Wealth book, which is that one. That one you pay full retail price for that because that's my newest one. So
are you going to sign them all?
Am I going to sign them all? I might. If it's a Christmas present, tell me and I'll sign it for you. How's that?
You just give a special trading message potentially in there.
Yeah, make money. Make money. Anyway.
All right. I hope you're enjoying the show so far. We've lots more to come. Before we get into that, now is a perfect time to go and hit that subscribe button. Also, make sure you like the video and we can bring more of these shows to you. Now, it's time that we get into the topic for tonight, which is predicting the stock market's next move month by month. Now, for decades, investors have been led to believe that October is the worst performing and highest risk month to be in the stock market, and January is one of the best. But is it really true? Just imagine what it would mean to your trading to be able to predict the higher risk times to be in the market. Would you stay out of the market and wait for better months? To sit out of the market 1 month and jump back in the next sounds crazy, which is why you need to know how to develop a strategy that really suits the way that you want to trade and your lifestyle, your goals, and the level of risk that you're really comfortable with. Now, not having a proper strategy is actually crazier. Okay, so that would be like coming to Melbourne without a raincoat, a woolly jumper and gloves, as well as a t-shirt and sunscreen. Now, I'm not suggesting that you only wear those items, as that might get you arrested. Now, I have seen people go to cold places like Germany without packing the right things. It's a crazy thing to do. Tonight we'll reveal the months in the calendar year that represent the greatest risk to your portfolio, and those which provide you with the best opportunity to profit. We will also share with you how you can manage your portfolio through all the ups and downs. Got all that? Okay.
I got it.
Yep. Put your
Okay.
seatbelt on and let's go.
Put your seatbelts on, hang on to your hats, get the whiskey out and we'll be right. We'll get you there, no problems at all. But let's take a look. First, we need to have a look at some of the data. So we're going to have a look at a couple of decades of historical monthly data on the XJO. And now, for those of you who don't know what the XJO, that's really what the benchmark index is for most of the funds. So it's the top 200 stocks in the Australian market. The XAO is the top 500. So we're going to bring up the XJO first to determine whether there are better times to be in the market, a month of the year to avoid. So on your screen right now, we've got Janine's brought up our spreadsheet. So hopefully everybody can see that. And I'll leave it to you to explain
Now
it.
I'm hiding the results. So I've actually just slid the page down. First of all, so I'm not showing you the top of my chart for that reason.
Sorry, just scratching my eye. I've got something in my ear. No.
Okay, so you're looking at the left-hand side of the chart, and we've actually got month by month the data from the XJO. Now, just for those of you who are not aware of the different indices on our market, we have the All Ordinaries Index, which comprises of around the top 500 companies on our market, and then the XJO, which is the top 200. Now, a lot of funds benchmark themselves against the XJO, so that's just something interesting for you to know. Now, then we've got the date month by month, as I said, and then we've got open, high, low, close. So this is just data, okay, that I've exported.
20 years, is it?
So this is 28 years, I think, of data that I've just downloaded to get a good sample to see what's happened over the history.
Did you pick that because that was your age?
You're all full of flattery tonight, aren't you? All right, so you can see there that the lines in orange show a negative. Now, I could have put them in red. I know Dale likes to see lots of red over things, so I made it orange on purpose, and I've put green underneath that to show the gains, some of the biggest gains for the year. And this is calendar year. So I've actually looked at, even though you can see, like here, for example, you can see December 93, and then you've got January 94. In 93, that was the month that had the highest return.
Okay.
And I'm looking down at January 94, and that was the month that had the highest return in 94. Okay, so the one above that was November 93, that had the biggest loss in the year, for the calendar year. Yep, and then down here for 94, that was the biggest loss for the calendar year. So got all that, we've got a process happening there.
Yep.
So as I said, we've looked at 28 years of data, and we've got some results here. Now, this hasn't been verified, so I'm just saying you need to, we're talking about concepts here, so you can go away and look at data and have a look at it for yourself if you come up with something different. I always like to hear from people. But we're looking here at the months down on the left-hand side in the next little table to the right, so you can see.
So that's January?
Yeah, so we've got January to December. Now, we can see that the best month, there were 6 months of the highest returns in a calendar year for April.
For April.
Okay, now that might surprise some people, but our reporting season happens in that early part of the calendar year. So it's indicating that there's a potential for positive gains at that part of the year. And we know that the story about, go away in May and sell in May. Yeah. So often what happens is brokers are telling people to sell their stocks towards the end of the financial year. Accountants, maybe, I don't know if they're still doing that. Maybe they're not allowed to anymore. But, that was always the trend that happened in history where there was this theme. Now, we see in May, it's actually showing 0 for the best months, and June was 3 positive for the best month. So if you look down the best month list, you can see down there I've highlighted September and October because they're not far behind, which is surprising, isn't it, when you think about it, because historically October's been thought to be the worst. But then the data is slim pickings. So you've got to look at this from the point of view that, okay, there's 28 periods there we're talking about where we're looking at. And we're talking about 6. 6 had the best month in April, was the best performance in April. The rest was in September and October. So if you took those together and you said, okay, if I looked at April, September and October, I've got 15 out of that 28. So that's almost half of the time. In those 3 months, I'm getting the best performance out of the market during those periods. Now, one of the things why this is important is because when we're managing client funds, I say to people, we don't need to be in the market all the time. So at times we'll be in the market when there's, everything's running well and there's clear direction in the market. Some of the big stocks are looking like that they're going the right way. then, you know, we're in the market more heavily. But we pull back from being in the market. We go to cash or predominantly cash as that uncertainty builds. So like big stocks like BHP, Rio, FMG are all pulling back. The banks have started to look interesting again. We need to see a bit more from them. So that's another big part of our market. So this is where this data can be interesting from the point of view of saying to people, well, you know, you could make most of the returns for the year in just a couple of months of the year. So we used to say to people, it could be 1 quarter of the year. You've waited, you know, you could wait 6 months, nothing much happens, and all of a sudden, bang, the return happens in the following quarter. So this is about patience, really. So then the worst month, we're then looking at, Dale, on the right, you can see. Is May. So there were an equal number of performing months there on the negative side for May's. But what was also interesting was that there was a 4 and a 4. There were 4 periods on each September and October where it went the other way. So while we
doesn't surprise me though.
Yeah, so it's interesting, isn't it? So while we had the second and third best months, September and October, so we had the data showing that was higher in those months. It was actually the opposite in the same months.
But remember when we talked about the Dow, the biggest and worst, best and worst days on the Dow, more than half of them are October, both.
Yeah.
So it doesn't surprise me that October has a fair share of the best months.
So it's just showing it's the highest volatility, really, to me.
It's the highest volatility month, and we've seen it again with October this year, haven't we?
Yep.
You know, it's all over the place at this point in time.
So you just have to be prepared for those particular months of the year that sort of volatility can happen, and this is about getting to know the stock market, really, and being, you know, have that awareness there. So I did that check at the bottom to show the 28 periods just to make sure that we tallied up the right number of years, and that cross-checked with what we found in Optima. So did you want to talk about this a little bit more? Like I've really hogged the conversation.
It doesn't. Well, I thought I'd do a little bit, but it doesn't really surprise me because, you know, we talk about time, price, and pattern. We're talking about the market, and we're talking about traders, and what happens, and we talk about how markets move from low to low, and the All Ordinary Index will have 2 lows and 2 highs in a year, basically. So it'll go up, come back down, go up and come back down again. So if you think you're like of an M shape, and that's what it does. So it doesn't surprise me that it has some good months and some bad months in there, 2 good ones and 2 bad ones in every single year.
Yeah.
And the good ones are probably going to be better than most, and the bad ones. So you're going to have 1 in the first half and 1 more in the second half. So then you're looking at maybe those lows are 6 months apart, or roughly 6 months apart. So looking at some of this sort of stuff, you start to get an idea of why those figures are why they are, and why some months just aren't like great months to be in the marketplace, because they're those in between months.
But a lot of people talk about, okay, what's the best month? But it means nothing if you don't then look at what the data says, what's the worst month, to get a feel for the volatility, but then going and having a look at the whole lot, the data set, not just the summary that I've shown you there. You've really got to scroll through it and think about what this is really telling you. And then can I show the seasonality chart now?
Yeah, you can. I know when I had an article that I was asked to write or give research for the Herald Sun a few years back, and I think they titled it Red October. Yeah. You know, because of October, and I went back and studied 20 Octobers, and I found it wasn't true. It just wasn't. There was not Red October. There wasn't the evidence there. More lows happen in September and November rather than October.
Yeah.
But just the bigger crashes happen in October with, 87, the 1932 crash, or 29 crash, sorry, from that one. They had more of the big moves happen in October, so that's why they called it that way. But as we showed with the Dow statistics, we had just as many rises in October that were just as big. So you can't really rely on that. So let's have a look at the seasonality chart.
Now this is actually showing you averages. So this is also over 28 periods, because of course it's the history of the data that I had for the other research. It's showing you the highest growths, right? So where you've had gains or losses, the thing about averages is that they're not telling you the full story, and this is why you can't just look at a seasonality chart. You've got to really look at the rest of it. So that's why we break down the data to have a look, because it shows you that April, so that supports the view that April has some of the best times to be in the market. But as I said, it was only 6 periods out of the 28 that was actually the case. So, and there was a reasonable amount on the other side of the equation for the worst. So what we're seeing here is July is also a reasonable month on the market.
That's July.
On average. And then we've got December is also another good one, typically for as far as averages go. But averages really screw things, don't they?
They do.
Because you get confused about what you're looking at when you're looking at averages. I remember when, there was talk about, well, what's the average return on, someone's asked me, what's the average return? Well, an average return tells you nothing because it doesn't show you the peaks, the troughs. It doesn't tell you what's likely to happen from a particular period from start to end. It really skews things a lot. Did you want to say something?
Well, that's why we need to do annualised returns and those sorts of other things, because there's multiple different ways.
Over a long period.
You can calculate returns in so many different ways, from capital weighted, cash weighted, time weighted. There's a list goes on and on and on for different ways of creating it. But what does this all tell us, though? It's more, how do we make money out of this?
Well, it's just telling you, it's just a flag really, which you can get it off the chart just by looking at a bar chart to see when the stock's more volatile. But this is sort of a more simplified version of trying to work it out. But it's just showing you that volatility can be higher in March, May and September, potentially to the downside.
Yep, so those are these ones,
yeah.
March, May and September.
But just like the data that I showed you before, even though the monthly data might have been strongly positive for particular months, it doesn't show you what's happened intra-month.
Correct.
Yeah, something to be aware of. So it was like someone said to me at one stage, if I looked at the returns on the calendar year, I got this, but then I looked at the returns on the financial year and I got a different figure.
And
you will.
Oh,
because you're looking at things at a different point in time. You could be looking at something at the end of the financial year and all of a sudden 3 months down the track, the return looks different because the market's unfolded differently.
So you've got a website or something you wanted to talk about as well?
Just to have a look did you want to have a look at the Dow as well, just quickly?
Yeah, that's the Dow.
So that's the Dow. So the
that
Dow
goes back to 1900. So that's 120 years of the Dow. Looks different, doesn't it?
But what's interesting is September's a big one on the downside there as well. So I thought, okay, if you've got the US market and our market both showing negative at the same time, does that make sense? Well, we know that our market's been moving in a very similar fashion to the US market over time, but there are differences as this seasonality chart shows.
Between this and that's ours, isn't it? Yeah.
Yep.
To me, that looks like a better trading, better
opportunities for a trader.
Than the Dow.
Yep.
So that's what that's showing for me, because you're getting more variances there. And looking, if you have a low earlier in the year, then after the low month, get into the market. And if you have a low later in the year, then you get into the market.
Yeah, so I mean, it's not necessarily that we're not saying just to jump in and jump out month on month. That's what I was saying is a crazy thing, because you actually have to analyse the stocks or the market that you're looking to trade and work out what the best strategy is over time. But it's just weighing this information up to explain what's happening, because some traders might be sitting there and thinking, I've had a crappy month on the market. Well, it may mean that there's a high probability as to why that is. It may not, and it may be your strategy is not right. Maybe the time frame over which you're trading is not right, but it could also be that's just the way the seasonality is.
But it is, and that's the point. That's really the point you're making, because people go, hey, look, March, I made a little bit of money out of March, and then, geez, I haven't made much money the last 2 months.
So I'm not consistent. Well, hey, I mean, it may not be anything to do with, it could be your strategy, like I said before, but it may just be the market.
Yeah. It's not about like getting an interest rate on a term deposit where it's just stable the whole time.
A straight line.
It's just a straight line.
Like you're dead. Like it's just not going anywhere, is it, at the moment?
Yeah, this is a heart monitor. So now you're going to bring up a website, aren't you?
Yeah, so now we've got, I just want to show you something that I got from the Harvard Business Review. So it says, consider the case of a statistician who drowns while fording a river that he calculates is on average 3 feet deep. If he were alive to tell the tale, he would expound on the flaw of averages, which states simply that plans based on assumptions about average conditions usually go wrong. The basic but almost always unseen flaw shows up everywhere in business, distorting accounts, undermining forecasts and dooming apparently well-considered projects to disappointing returns. That's why you've really got to consider returns in isolation, not looking at just the overall figure. You've actually got to look at what the volatility is in any period to really understand what's happening. I mean, we've seen many times that some of the big funds, they drive the market up towards the end of the quarter to hide that volatility. But what that does is give you a false sense of security. And then when we go into a long-term decline like the GFC, where the market could be down for a year or more, then you'll be wondering what just happened. So then, that's what the issue really is. So important to bear that in mind.
Okay, so Janine, where to from here? We need to look at a bar chart of the XJO
Yep.
And so when are the highest risk times in the market? So we need to do that. And the third thing we need to do is if selecting months of the year is not reliable, what can traders really rely on?
Okay, so first if we look at the chart of the XJO, really what it's about is saying, you know, that data we've looked at is all good and well from a shorter term perspective, and also getting a really appreciation of what could happen in particular times of the year. But it's about now looking at, well, okay, does that really help us in the end when we're looking at a chart? And the answer is that it can help us for short-term trading, but I think for more medium to long-term trading, it's not going to really make that much of a difference to people's trading.
No, not necessarily. If you're medium to long-term trading, you're going to expect, you should expect that you're going to get rises and dips over the period of time. And so you accept that you'll get dips throughout the period. If you're a short-term trader, the whole idea is to buy low, sell high. That's really what it's about. But medium to longer term, you're not buying dips, you're just holding it through the whole period of time, knowing there will be dips in there.
So if we worked on the seasonality chart, it says December's going to be up, right? And we looked at the times where September or October had a reasonable probability, along with April, of being up. So we're in that September-October period, and yet the market's sideways. Right, so that's the interesting thing here. So it's not necessarily going to unfold the same way every year, but if you were to toss a coin, that's probably the next.
That's what we do as great traders. We just toss coins. Yep, it's heads, we're buying.
So what can people really do?
Yeah.
That's the thing. I mean, if you have a good set of rules that you're buying and selling. So if you, for example, wanted to trade an index like the XJO and you look over the history of it, there's some really good rules that work well on the All Ords to be able to trade it over the short term and the medium term, to capture some of those ranges and to make an income from the market, or just to get some growth there. And I think that's probably the best thing that you can do right now, is to start thinking about what sort of rules can I use in the market to take advantage of any rise that comes. Because we could be heading into a rise towards the end of the year. It's possible, but we'll know actually in the next couple of weeks whether the market's going to go up or down.
I've sort of said, because of what happened last week, because the market was looking a little bit more bullish prior to last week.
Yep.
Last week was a bit bearish, as we saw. We're not sure what's going to happen this week, but if this week we close lower, then we might get one more week down, maybe two. But after that, I'm pretty confident the market will be bullish. But if we don't get a week down next week, let's say this week holds where it is and next week pretty much holds where it is, I still think it'll go up into Christmas. So I still think either way we're going to get a good December. I'm not sure about November, but I think December will be good, probably even into January.
Well, if we go back to the spreadsheet for a minute, right, just having a look, we can see there that the worst months in that first quarter of the year, there were 6 or 7 periods there. We had the worst month in either January, February or March, but it wasn't a high number in any one month there that we're seeing. It wasn't until May that we saw that happening. So that's telling us that it's really either way. Like, you had the best month in the first quarter a number of times, but it's not an absolute. You need to go and look at the individual months to really determine that.
Can I sort of add a little bit with the presidential election? Obviously, every time they do a stimulus package, the market goes up. If the US market's going up, we're going up, because the last 10 years we've been following a lot more than we ever have from that. If Trump gets in, the stimulus package will happen sooner, because he's already president, blah, blah, blah. He already knows what he's going to do. He'll just release it. If Biden gets in as president, he's not inaugurated till sometime in January, I think mid-January. So the US is in a stalemate, because the Democrats and the Republicans basically don't even talk, and they don't agree on the stimulus package. So Trump's unlikely to pass one before Biden gets in. So whenever that stimulus package is, we'll know the market will bounce. We know that, because the one thing we know is it will happen. We're just not sure when it's going to happen. So it'll be interesting to see what actually happens.
Or they're fearful about unrest erupting.
And there'll be a lot of possible riots. There'll be lots of legal actions, all sorts of stuff. And for people to watch,
but you see, that doesn't necessarily impact on the financial system.
No, it doesn't. The stimulus package will.
Yeah, so that's the kicker. It's anything that impacts the financial system, the stability of it, can cause negative a negative impact on the market. But let's not forget that we've got all of those gaps on the US chart that could push it south to fill them.
Yeah, so anything can happen at the moment. It really is, and that's really how I think the market is. Whilst we probably sound a little bit non-committal, we're sort of thinking the market is a little bit more bearish short term. And some people think when we start talking it's bearish, we're talking about crashing. No, we're not. We're just saying
it's just that it's been going sideways now for so long.
It's just sideways. It's got to pick a direction soon, and we're thinking it's down a little bit and then moving up through to Christmas. That's what we're looking at. But I think what you're showing at the moment is fantastic stuff. You know, because it shows people how the market moves and when there's times to get in, when's the times to get out. So traders can really use this stuff to their advantage, big time. Investors, probably not so much. It could be just, is it better to buy earlier in the year or later in the year? If you're going to invest, like let's say you have a plan where you invest $10,000 a year in the market, do you wait till January, then go in, start of January every year and just keep putting 10 grand a year in there and just buy and hold? Is that a good strategy? Or do you put it in September, October, 2 or 3, 4 months earlier? Or do you put it in June or after the tax year, 1 July? Where do you put it in?
Look, I don't think it necessarily matters what month you put it in, as long as the strategy's good and you've got some risk management in place to do it. Then, but clearly there could be 50% of the months of the year, if we're looking at April, September and October, 50% of that 28, we showed the strongest moves in that time. So it could be that a better return is had, but then it depends on what the market does in the months after that still.
Cool. I love what you've done. So we've got more research to come, haven't we?
We do.
Not tonight.
Not this show. We can't show it all on one night.
Cool.
Now let's get into some emails. But before we do, remember to hit that subscribe button now. And whilst you're there, give us the big thumbs up.
Big thumbs up. Well, the camera's not on me. There's the big thumbs up. Yeah.
Now it is.
Oh, now it is. And hit the like button too, guys. Remember to hit that one as well, because Janine and I do really appreciate it, and it really does help people find our channel and get more educated. And we do love helping people and answering all your questions. So the more people that watch, the better. Now, we do have a question from a gentleman called Alfred, who says, Dale, the intensity of the bots trading is making trading impossible. Can you tell me where to go to get help with having them banned? The ASX should be ashamed, Alfred. Tell it like it is, Alfred. Give me some strong words on that one. So, geez, we agree, and we absolutely agree. I think if it was last week, we got a bit hot-headed on that?
Yeah, because we talked about the increase in volatility and how this has happened from the 87 crash onwards, and the increase in the algorithmic trading has increased significantly from that time. So, you know, the industry always argue that we need to create volatility by having these different strategies in the market, shorting, etc., and using the automated trading strategies. But we argue that that's not the way that it's done at the moment. It needs a really close look at with a magnifying glass and stop taking what the industry say as gospel.
Oh, yeah, and I think, where do you go, ASIC, mate? That's exactly where you go, Alfred. So you complain to ASIC about the algorithmic trading. I don't agree with you, it's made trading impossible. Trading is absolutely possible at the moment, and you can make a lot of money using the volatility to your advantage if you have the right rules and structure and strategy. There's a lot of money to be made on the market if you've got that knowledge and the experience, but I 100% agree with you.
But if it was less volatile, you could still make money on the market. You
less
just have
volatile,
to have a good set of rules.
It's just a little bit easier if it's less volatile, and like trading an index is easier than trading a volatile stock, because an index is smoothing things. So you're getting a better average, if that makes sense. So, but totally 100% agree with you. Generally, I hate algorithmic trading, high frequency trading, all of that stuff. Just because they can create a product doesn't mean it should be there. But complain to ASIC, that's the place you go to. Don't complain to the ASICs, they don't care. No, they do, but they're not for that.
Okay, you're a funny man. The next email we have is from Joe. Hi Dale and Janine, I purchased Worley 10.50, Atomos at 79 cents, Elders at 12.03 recently, which were appearing to be bullish at the time. Now, I thought I put Elders in there, but I can't see it there.
Yep, it's Elders you've got here.
Yeah, I've got it there. And they seem to be in decline. Could this be due to the current stock market uncertainty? I'm hoping that they will start to show some strength again soon. Should I be holding these stocks for a more long-term view? Please tell us. Thanks, Joe. All right, good question. Lots of stocks there. We thought we'll cover off Elders anyway.
I think he's a bit early on Atomos. I like Atomos, but I think he's a bit early on Atomos.
Yeah, he said it was in decline.
Yeah, I don't like. Sorry, I was going to say I don't like it. I don't like it. I do like Atomos, but I don't like it right now.
Great. All right, so Elders we can see has been trending up really nicely. It looks like a bit of short-term volatility on the weekly chart. So look at the left-hand side of the chart. It almost looks like it's flatlined, but you've got to
Looks like something fell off a cliff.
Yeah, look at it more relative to the more recent years. So if we're looking at this big rise, it's had an incredible run and it still looks strong at the moment. It's not to say that it's going to stop there, but we just need to wait for a bit of confirmation to see whether it's going to continue to move up or whether it's going to come back and find support around this $10 mark. So really the next couple of weeks are probably critical for Elders. If you weren't in the share, then I'm not saying it's a buy right now. I think it's had a good run. I'd suggest to wait for another opportunity and just check to see if it does pull back in the short term. But if it continues up above this $12, probably $12.20, $12.30, then it might continue to trend higher for a few more months yet.
There's interesting spread of stocks. You've got Worley, Adamos and Elders.
Yeah, it's good to see the diverse
interesting
selection.
spread of stocks. I mean, obviously Worley, if you got, obviously BHP, Rio, Fortescue.
Mining.
Fortescue runs a bit differently than BHP and Rio.
Yeah.
So looking at Monadelphous and
Worley's
Worley.
more in the services side.
Yeah, all that sort of thing. So it'd be
Supporting
interesting to
that
see if your BHPs and your Rios start to find support and run where the Worley would actually run.
Yeah.
But interesting. I like your stock choices. Probably not necessarily, I mean, Adamos, as I said a little bit earlier, but I do like your stock choices, so well done, matey. The next question we got is from some good-looking dude called Nick, who says, "Hi, guys, thanks for sharing your knowledge and experience for free. What an amazing way to give something back." Thank you very much, and we do like, I'm glad you appreciate it. But he's asking about looking at personal leveraging versus using products rather than a personal loan.
Right.
So which option is actually financially more efficient for tax purposes and poses the least risk? For example, would it be more beneficial to trade CFDs or equities using a personal bank loan? Would be great to find out the pros and cons for both options, including your
Well, first of all, we
insights.
can't really give you personal advice. However, we could just give you an opinion on lending from the point of view of, well, more the leverage, really.
Well, it's understanding it, I think, because the tax is the same regardless of whether it's a leverage in a personal loan or whether it's using something else, how it all works.
But CFDs is leveraged, it's borrowed funds anyway, essentially.
Well, it's
not
implied
really
borrowing.
borrowed.
It's implied borrowing.
Right? So you're actually putting borrowed funds on borrowed funds. But I once talked to someone about their borrowing this way, in that a lot of us have loans on our homes, okay? So we have loans. Okay, so when you go out and you purchase something, doesn't matter whether it's your bread, milk, whatever it is, clothes, you're actually essentially using funds that could be used to pay off that borrowed money.
Correct.
So essentially you're still using borrowed money. The bank owns your, a percentage of your house. You only own a small part of the equity of it. Because if I had, $50 to buy groceries and I spend it on the groceries, it's gone. But I could put that $50 off my loan and pay it down. I'm paying less interest.
But then I'd die.
That's right, you'd starve. But do you see my point, though? So if you're then taking borrowed funds...
I'm hanging in there at the moment, but I'm not sure I'm with you yet.
Well, if you're taking borrowed funds and then you're going and putting it on leveraged products, what are you doing?
Okay, so you're saying by borrowing money, you're spending tomorrow's earnings.
That's right.
So yeah, I'm with you.
So, yeah, so essentially, if you were spending it on the milk and the bread, which are necessities and you have to, obviously you don't want to die and we don't want to see you get too skinny.
Yeah, well, I need to be a bit more skinnier, but anyway, so...
Okay, but I'm talking about, buying other things like, just expendable items that you don't buy, but you don't go shopping anyway, so you probably wouldn't be buying anything.
Well, my first question always is, do you need it or do you want it?
Yeah.
And if you need it, then that's okay, but if you just want it, then it's probably not okay. And what I find is successful people or wealthy people don't necessarily waste a lot of money.
I know, but there's another side to that. Someone said to me that you've got to have a balance, and so if there's something that you want, why wouldn't you have it if you wanted it at times? Like, there's got to be that balance.
Where's the cut-off point?
Because if you're only buying what you need, you're not satisfying whatever it is, that inner child. But you're right there. There's got to be a cut-off point as well.
Otherwise, it's too greedy. Anyway, but we're getting off the topic.
But that's a belief,
We're getting off the topic. We're getting off topic. We're talking about leveraging it. Personal loan is unsecured loan. That's what it is, and there's interest rate in that. And you buy, let's say you get 10 grand on a personal loan, you put it into stocks. You own the stocks. You own those stocks, mate. That's what it is. So, and then you just pay the bank back. The bank doesn't have any recourse over those stocks, but they're all in your name, and that's fine. And you pay the loan off. If you're using a CFD or you're leveraging through that, as Janine said, it's implied borrowing in there. There's generally there's fees in there and interest rates in there. but you have a margin account. Now, when you're placing your trades with a CFD provider, they're an over-the-counter product, so they're controlling the whole process and showing you the data that you need to share. And so they will actually sell out those shares if your margin gets out of kilter and all that sort of stuff. Different situation. If you use a margin loan, it's similar to using a personal loan, but a margin loan is pretty much a secured line of credit, for want of a better way of saying it. They take securities over the shares are in your name, and the bank who's giving you the margin loan, or whoever's giving you the margin loan, will have security over those. So if your margin gets out of kilter, they'll start selling down your positions till you're back in line again. So you've got to look at the different forms of leveraging. You can leverage quite highly with CFDs at the moment, but that is changing. ASIC's changing all that with FX and CFDs to protect people. But the question was all sort of on tax, and tax is treated exactly the same regardless of whether it's a personal loan, a CFD, or whether you're
still need to see your accountant.
It's always about income and expenditure, and interest is expenditure, and income is obviously dividends. And if you sell down stocks, whether you treat yourself as an investor or a trader, so you can be both in the same body. That sounds a bit schizophrenic, but you can actually be an investor and trader. But that's a question for your accountant to work that out for you, what's the best way for you. But basically, at the end of the day, the tax is pretty easy. It's really, are you in a negatively geared situation or you're a positively geared situation, like you do with the house? It's the same sort of thing. But hopefully that answers your question. If not, you know exactly where we are to give us another one to clarify a little bit more.
Do you need a drink now? You've got all that out? Okay.
We're fine.
We have a question from Michael. Hi guys, what jobs could someone apply for if they were to complete any of your courses? Cheers.
You can handle this one.
Well, that's interesting, isn't it? Look, we have had quite a few students that have come through and done our courses, and they've gone away and got jobs in the industry. And I mean, I think from my perspective, if you're in the market, in an area of the market, it could give you an edge in terms of if you're in the trading area of some big institution.
It will.
But then they have rules, and they may have very strict criteria as to what you can follow anyway, but your understanding of things would be different. But what I'll say is that some people who go into the industry are very, I guess, how could I say, blinkered in terms of their understanding about trading in the market. So this would actually broaden your view, and you would be probably in the 1 and 2% of people out there that have this knowledge, and it may, you know, on your CV give you something that somebody else doesn't have, and give you an edge, as I was saying. Now, our course was actually rubber stamped. Didn't we get someone from Commonwealth Bank that actually said that, you know, that there is a need for this sort of education out in the marketplace?
They employed one of our students because of our course. Now, whilst they weren't being a stockbroker, they were employed by ComSec. They weren't. They were part of, I think, customer service. They weren't part of they weren't going to be a broker, but they were still employed because they'd done our course, because they brought their understanding of the market and how it all works. That's really why they took it on. But we've had students with stockbrokers, fund managers, financial planners, accountants.
Yeah, look, I have seen people go into financial planning, and that's been frustrating for some people, because that is also very restrictive in terms of what you can and can't do. And so people were seeing that investing was being done a certain way, sticking to particular models and just managed funds. And the person who I spoke to didn't agree with the way that it was being done, because he could see...
we've also had lots of students who are financial planners, and they have some discretion in managing portfolios, and they've found it very beneficial for them, for their business.
Yes.
But we've also had financial planners employ some of our students to be the behind the scenes running portfolios for them, and then giving those recommendations to the planner to give to the client. So we've seen that. But
well, we've also seen financial planners who, in their little business group, that someone comes along and says, okay, I've just done this course, and that actually puts them ahead of the people in that team in terms of their understanding of the market.
And I think that's the point.
Amazing.
It's if you've got two candidates going for a stockbroking role or an FX broking role or a fund manager role, and if they've both got qualification X and one's got qualification X plus our course, you're pretty much going to get the job. Basically, that's what
I wouldn't say that necessarily, but I would say that because it depends on the criteria that the financial planner is looking for, and the person, because it's not just about the qualification, it's about that individual as well.
It's about the person himself, but you're going to have that edge by having a qualification. That's what our students have reported back to us. Because I've got that, I got more in the door. We've even had students being poached because, you know, on LinkedIn, they've got our course accreditation on there, and they've been poached into different places. So we've got that. But anyway, we need to move on to the next question. I'll be here till midnight.
Okay.
So, this is mine. Sorry, guys. The next question we've got is from Nola.
You were trying to get me going, and it was your own question.
It was. And this one's about ETFs. I actually did answer this question on my market report yesterday, but I wanted to bring it up with you because I'll read the question. So Nola's saying ETFs, are they worth considering for medium to long-term investing? So I wanted to get your opinion, so I thought I'd bring it up tonight.
Yeah, look, I mean, I know in the past that you and I have had a few punch-ons. Sorry, no, we didn't actually, just debates about this one, because I've always said that, look, if you want to trade ETFs or have ETFs in your portfolio for a long-term investment, go for it. I don't think there's anything wrong with having them in the portfolio for long-term. But what I will say is that even if you're buying something for long-term, you still need to know how to manage your risk, regardless of whether it's an ETF or a stock, because they do go up and down. So there'll be volatility in a share. It just, to a certain extent, will get flattened out because the exposure, depending on the ETF, has a broad investment of different equities in it potentially, depending on what the ETF is investing in. So therefore, it will flatten out the volatility of some of the individual shares that are moving in that ETF. But I'd say that, if you're wanting to put some ETFs in there for the long term, 1 to 5 years, I'd say, the market has a cycle, okay, and the market moves in cycles of roughly 12 months. And then there's a cycle of around 2 years, and it can also be anywhere between 4 and 6 years as well. So depending on the time frame you're thinking, you could be buying an ETF at a low, but then you could be riding it all the way into the next one. So this is why you really need to understand how to manage a stock or ETF. It doesn't, eliminate the need to actually manage it, is what I'm really saying.
Don't just blindly leave it there.
Yeah.
Okay, cool. Next question.
All right. The final question we have is actually from Tony, who asks about long-term investing. So, this was the 1 to 5 years that I was thinking of.
Well, Tony, we asked a question saying, what sort of topics would you like us to cover? And he's saying, long-term investing 1 to 5 years or more. Now, we've covered that a lot in other previous shows.
But why is that important to him, though? That's the thing we're missing from his email.
Well, long-term investing is more 3 years plus for us. Not 1 to 3 years is medium-term investing to us. 3+ years is more long-term investing. If you're somebody in the financial services industry, it's 5 years or more is longer term. Anything under 5 years is shorter term. So it depends on how you classify that for yourself.
Well, in direct equity, we talk about a 5 year plus time horizon and for that very reason, as I was saying before, that cycles move in roughly 4 to 6 years. So when someone rings up and we talk about it, I just discussed that, it could move from low to high to low in that period of time. So, and this is why you really need to be if you're going to be in the market, you need to have a long-term view to get the opportunity to get some of those gains. You could see some really good gains, a couple of either high single-digit or double-digit gains in a couple of years of that first part of the cycle. But the last part of the cycle is always going to be down, and you being an individual may not know where you're starting, and there's always going to be some downside as part of that last move down into the low.
We've done a number of these subjects in these. We've been doing these live shows for 2.5 years now. Yeah. And I know we've done a number of them on portfolio construction, position sizing, diversification, risk, money management, those sorts of. They're the ones you need to watch. Yes. Because they'll help you with what this is.
1 year's not long term though. No. That's more medium term.
Yeah, that's what I'm saying. Up to 3 years is medium term. 1 to 3 years is medium term. More than 3 years for us is longer term. But for the industry, it's 5 years plus.
I would have even said 18 months and up's more longer term.
Get the book for free, just pay shipping. Tell you all that. Give you all the answers in that.
Yep, great. So what are we going to do next?
What are we going to do next? Well, you're up next, not me. So you've got to read that anyway. But sorry?
This is what I said before, isn't it? What's the best return? So, because what Dale and I were talking about...
So this is where the drum roll.
This is where I need that drum roll. What Dale and I were talking about is that you guys are sitting out there thinking about particular stocks. You're thinking about returns. But we really want to know, what's the best return that you've ever made on a stock, and when was it?
So Janine wants to know.
So that's important, not just the stock code. So get the code. If you don't know the code, type in the stock name and when you actually
So put it in the comments below. So point to the below. So you go below and you point down that way. Down below. Point down below. Stick it in the comments below What's the best okay.
Yeah, it's getting a bit stuffy in here. Can we have some air, please? Unfortunately, we've come to the end of tonight's show. We hope that you've enjoyed the discussion tonight, and thank you. We've enjoyed it, haven't we?
I always enjoy it.
Remember, your questions are important, so don't let them go unanswered. And also, if you have a topic that you'd like us to discuss for the show, send in your ideas and we'll have a look at your requests for our next show or further shows after that. So we've got, how many more shows have we got? We're running out of time, aren't we? It's nearly Christmas.
We're running. Actually, I think we're going to have a special offer for people for do our course we're going to put out about next week. So we might have something special for you next week, but we've probably got about 6 shows left for the year. We're working on what we're going to do. But remember, hit the subscribe button now. Like our video too, please do that. And also remember to share the video of tonight's show on the social media with your friends, so Facebook, Twitter, Instagram, you name it, whatever those. But let your colleagues know where we are and how to find our videos. It really does help us because, as you're seeing, we're helping everybody here freely of charge. So, but as the participation grows, we can deliver more and more interesting topics and informative things and data for you, because it does take time to do what Janine did tonight. But also remember to put this show on your calendar, as we'll be right back here every Tuesday night on YouTube live, 7 to 8 p.m. So stick it on there for next Tuesday.
If you'd like to have your question answered on the show, either send your question in an email. Remember too, video questions have a priority. We like to see who our listeners are, so please send in your video questions. And we need a lady. Remember, Dale said that he's after a lady to send in a video. Why is that? You're being sexist?
Well, we've only ever had men.
Okay.
So how's that sexist by asking for equal participation?
No, that's the opposite of it. And type Wealth Within Live in the subject line. You must do this before 3 p.m. Tuesdays to get into that night's show, unless we're feeling super generous. We really hope everyone enjoyed the show tonight as much as we have. As always, thank you for joining us, and we hope to see you again next week. For now, goodbye, good luck, and good trading.
No, you're going to punch me again later, aren't you?
I couldn't see your name at the edge of that one, so I just read it.
Bye, guys.
Bye.